Hello everyone, this is Ashish with Investor Friendly CPA. Today's topic is which retirement account is better for you, Roth or non-Roth? So everyone understands what non-Roth or traditional retirement accounts are and what the Roth accounts are, right? So let me just recap really quick. Traditional non-Roth, I'm going to call it non-Roth accounts. You put the money right now and you get the deductions for tax reasons, right? Later in the year, when you take the money out, when you retire, the money is going to get taxable. The reason you put the money in this type of account is you expect your tax rate to go down when you retire. Meaning you save right now by contributing to it because you're in a higher tax bracket. And in the future, when you retire, your tax bracket is really low. And when you take the money out, the money get taxed at a lower tax rate anyway. So you're making that difference right now. Roth account is you put the money in, you don't get any tax benefit or nothing. You get taxed in even though you put the money in retirement account, you still get taxed in that one. But eventually, when you take the money out when you retire, there's no tax. And people usually do this when they expect their taxable income to be a lot higher in the future. Let's say you're going to sell your business or you're doing really well in your business, you keep on going up, you have very exceptional career goals. That's how people think. Now, is that a good thing? Yeah. So this is normal. You should think like that. However, if you're an investor, real estate investor, or if you have any big losses coming in the future, you should think the opposite. And that's what I'm going to talk about today. So just think about this. You're an investor or you're going to have a loss in the next few years because your business is going down for various reasons, okay? This is how it's going to work. You buy a property, let's say a $5 million, $10 million property in the next few years, and then you're going to have this huge loss from cost segregations and everything. And you have seen these videos, you can watch what those are. Let's say the real estate hardness is a big loss for you. When that happens, what you should be thinking, you're going to have income to use those losses. That year, you're going to do Roth conversion. So this is what you're going to do. As an investor, maybe a non-Roth account is going to be better for you because you're going to get deductions right now. Every single year, you're putting money into 401ks or IRAs or whatever you use, you're saving tax at the highest tax rate, especially if you're in 37% or if you're in a taxable state, then you can save almost 40% at the minimum, right? You're saving 40% of your highest tax bracket every single year, you and your spouse. It applies to both of you guys. If you put in $23,000 each for your 401k, that's $50,000, right? We're talking about saving 40% of that every single year. That's a huge amount. Let's say you do that for the next 10 years. And in the end of 10 years, based on your real estate goals, you're buying this huge apartment building, and this apartment building will create a huge loss for you. That loss now can offset any other income if you plan your taxes correctly, right? That year, you can do Roth conversion and convert this non-Roth account, which you have been saving tax all the way to 10 years, to Roth account for free. Because when you convert to Roth, it's going to be taxable, but you have losses to offset that income, so there's no tax. So what happens is like three benefit, right? When you first contribute to the non-Roth account, you're saving taxes. When you convert to Roth, you also pay no taxes because you have this huge loss for real estate or any other avenues. And then now when you retire, you also get tax-free distribution from Roth account because you convert it to Roth and you harness because you had this huge loss from real estate. So this really depends on your goal. What is your future goal? If what I said aligns with your goal, then non-Roth account is probably better for you right now. If you have a normal career and what I said before about you being in a lower tax bracket compared to right now, then maybe traditional account is better for you. If you are going to be in a lower tax bracket later in the year, then yeah, traditional account is better for you. So this only accounts for tax implication. Remember, retirement is more about overall financial planning, your financial health. So make sure you talk to your financial advisor which one is better for you. And also layer in this concept because they might not know tax aspect of retirement account. So layer in this concept to come up with the optimal retirement planning for you. I hope this was helpful. Thank you for being part of the video. One more tip, please subscribe and like, and we'll see you in the next video. Thank you. Hello everyone.